Welcome. This is the session on client data analytics. And, there's been a lot of promise around the advent of technology and how that's going to change the picture of financial inclusion. A lot of the talk has been around the first challenge, which is how do you drive down the cost of delivery? So you've got these agent models, you've got the mobile phone, you've got the cost of delivery down such that you can reach the last mile. The second piece of the puzzle becomes, now that you've reached that last mile customer, how do you drive down the cost of assessing them? We've figured out that they are good credit risks, as microfinance has proved over the last 30 years. They had a relatively high-cost model. They went around and understood your community and used that as the basis for underwriting. Can technology change that equation? Can we have a scalable, at your fingertips, instantaneous model that allows you to reach the mass market? To answer that question, we've got a fabulous group of panelists, and I'll give you quick introductions and then move on. To my right, Dr. Narda Sotomayor. She's the head of Microfinance Institutions Department and a senior economist at the Superintendent of Banks in Peru, and has been intimately involved in this project and has been part of the tech working group for the last 15 months. And joining her on stage are 4 entrepreneurs that are reimagining what the future of financial services could look like, all from the perspective of analytics. Jeff Stewart, serial entrepreneur, co-founder and CEO of Lenddo. Jojo Malolos, the managing director of Cignifi, though I'm sure a lot of people in the crowd remember him from his days at Smart Money in the Philippines. DiDonna, the co-founder and chief operating officer of the Entrepreneurial Finance Lab, and Mark Hookey, the founder and CEO of DeMyst Data. I want to start with a quick poll. And so I'm on a technology panel. I'm not sure I'm going to get this to work, but that's why user interfaces are so important. Okay. We did this earlier this morning. I'd love to get a sense of who's in the room and who found this of interest compared to the broader audience that was here earlier this morning. So for those of you that can't read the fine print from the back of the room, number 1, regulator or policymaker. Number 2, established financial services provider. Number 3, startup or technology disruptor. Number 4, donor or investor. And number 5, consultant, researcher, support service provider. So if we can start the poll. I think most people should have one of those clickers. Okay, so we've chased away all the regulators and policymakers. There were a lot more this morning. Otherwise, it's more or less, no, actually the financial service providers have increased quite a bit. Okay, that's great. So just to frame the problem, Narda is going to talk about the challenges of trying to reach thin file clients. So how do you understand these clients? In the emerged markets, we have credit bureaus. I can go rent an apartment. 30 seconds after meeting the landlord, I can download a credit score. There's an instant verification. People understand who I am. How do we create that mechanism, and what's lacking in the emerging markets? Narda will hopefully give us the point of view from Peru, but also a broader understanding of the markets, because she is integrally involved in the debate in the global south.
Okay, thank you, Arjuna. Perhaps I will start saying that in recent years, financial inclusion has become a top priority in most of the countries worldwide. And microfinance has been recognized as one of the activities that are able to provide financial services, especially small consumption credits and microcredit to low-income people. In fact, the most visible innovation in microfinance has been the design and development of adequate technology to serve low-income segments of the population. Microfinance has enabled, has been designing these technologies in order to provide services to people who lack a lot of information, even identity information, who have very small loan demands, lack credit history, lack ways of identifying themselves. They don't have credit history in the financial system. So this is really a challenging activity. And microfinance has focused the efforts particularly in trying to evaluate the customers based on character and based on the evaluation of cash flows elaborated by the official, that the credit officials are the working place of the entrepreneur. And character is evaluated based on very intensive data collection, almost using primitive ways, developing very close relationships, collecting information, checking personal information through the neighbors, through community authorities. But all of this is really expensive, really implies very high cost. And for microfinance and in general for the financial sector to advance, it is important to scale up in these activities of reaching the poor. And operating cost is standing in the middle because it's necessary to cut down operating costs in order to generate growth and in order to reach at least a portion of those 2.5 billion of people lacking access to financial services. Of course, if we are looking also for sustainability in these institutions, interest rates must be high, I mean, reflecting this high operational cost. And we have a long experience already in the sense that controlling interest rates is not the solution. Actually, the key element is finding the way of cutting down this operational cost and overcoming the barrier of information. Microfinance, again, referring to them, sometimes find very difficult to reach the people who lack of this information, and they have to use, when it is costly to do it individually, group lending technology in order to use the information that the members of groups have about their peers. So, but this imposes cost to the members of the group. So it's not necessarily the most effective way to reach. So I hope we can get some insight here in terms of how to use or how to search for information and how to use alternative sources of information so that that can be used to evaluate customers in a more effective and sustainable way.
Thank you, Narda. So we've heard a lot about this notion of big data and the promise it holds. I'll give you one, and that's the question, what is this big data, right? We use it in capitals, we use it within quotes. Here's one view of it. This is Dan Ariely. He's a published author. He's a professor of psychology and behavioral economics. He spent a lot of time at MIT. He's now at Duke. And I sort of edited the comment, but I'll say it now. He actually says big data is like teenage sex. Everyone talks about it. Nobody really knows how to do it. Everyone thinks everybody else is doing it, and everyone claims they are doing it, right? So this is where we're starting from. It's such the rage. Everybody talks about big data changing everything. I'm going to give you a very simple rubric within which to think about this. And this actually comes out of research that IBM has done. They use something they call the 4 V's of big data. Volume, variety, velocity, and veracity. So what's volume? Volume is just the sheer amount of data out there. And it's measured in words that modify the word byte that I can't pronounce and I cannot remember. And I didn't know existed, right? So it's in something bytes. Being added to every second. Velocity is the rate of production, right? How much is being added at every second? The production of data is incredibly rapid. Can real-time analytics yield better business decisions in that framework? The other issue is variety. It's mostly unstructured data. And structured data, very simply, is something that comes in that's a row and in a column, right? I know where to look. It's in this row and it's in that column. This is coming at you in video feeds and Twitter feeds and LinkedIn feeds and little sensors and machines and how people interact with all of the technology that's in their hands. And finally, veracity. It's often incomplete. It's often inconsistent. There's potential for deception. So it's how do you make data-driven decisions with traceable and justifiable information? So those are the 4 real key elements of what I would call big data. On top of that, you need to figure out how to add value. And that's my 5th V, which one of my colleagues and I sort of cooked up. You need the intelligence that sits on top of that stream of data that's coming at you that allows you to make smart decisions. Before we hear from some of the innovators that are working with big data, I'd just like to get a sense check of where the audience is, having heard Professor Ariely and me. All right? So what do you think? And please use your clickers. Number 1, Dan Ariely is spot on. Big data is all hype. No way do I want someone to be using all this information about me. Or, this big data stuff could be a game changer for financial inclusion. I can't see the tickers. That's no good. I needed a lot more skeptics in this room. I guess they didn't come. The ones that were interested sort of were buying in already. Well, we've got 20% of the audience we might want to change their minds with. So I'm going to turn it over to some of the innovators in the room. I think we've got an interesting way of building this market. I'm going to start with you, Jojo. If you can talk about Cignifi and help bring this from the abstract of millions of records to something simple about how someone who's financially excluded might benefit from the service you provide.
Okay. Hello. Yeah. So good afternoon. Maybe the best way to present is for me to ask a few questions and do some data analytics myself right now, and then ask who amongst the audience are actually using their phones daily for work. Maybe show of hands. Who are probably using the phone to communicate with your relatives? Who are probably using it at least 25 minutes of voice call a day? So, we're getting very, very specific. Who are sending SMSs of at least 25 SMSs a day? 35? Who are using your phones more in the mornings than in the evenings? So, I mean, these are behaviors that are reflected and imprinted on your mobile. Similar to us who are capable of borrowing money anytime because we have records and we have credit history, Cignifi believes and knows that there's a good portion of the prepaid population, most of whom are financially excluded or don't have credit history or records. We believe that by looking at their behaviors, it gives us an appreciation of their lifestyle, financial capability, financial ability, family lifestyle. And these attributes basically dictate their propensity to respond positively. Maybe their propensity to take risks and their risk appetite. Or maybe their propensity to accept an offer. Can be an offer on financial services, can be an offer around some telco services for that matter. So Cignifi runs a scoring engine that basically churns out credit risk scores, response scores for anybody who has a mobile phone. By looking at these behavioral dimensions, you're able to create an opportunity for, let's say, a borrower of, let's look at Ghana, one of the markets we're addressing. Somebody who's a prepaid subscriber, no credit, let's call him Roland. And then he does not have any credit history, no records. But because when we look at his behavioral dimensions, we are able to find out and establish that he indeed has this propensity to accept an offer, financially capable to pay a loan. And that's what's important to microfinance companies like microfinance institutions in Ghana who are willing to offer this to people who don't have records at all. So by looking at the prepaid subscribers, Cignifi knows that there's a good percentage of these people who can be excellent borrowers. And what we do to increase the level of confidence of microfinance companies or financial institutions offering the services is that we give them a flavor of how capable potential borrowers are, and their willingness to accept an offer, at the same time their ability to prepay or to pay their loans. By looking at this behavior, similar to the behavior that we just expressed today, we believe that we're able to identify and rationalize, and we know, based on the data that we have right now, that the behavior dictates their propensity to get a loan or pay it in fact. So, and then we partner with companies who have access to this data, MNOs. We partner with financial institutions who are willing to take some little bit of a risk to offer credit products to a bigger portion of the population, thereby increasing the probability of scaling their initiatives on financial inclusion. So that, in essence, is what Cignifi is doing.
And Jojo, if you can just for a minute talk about, you're running a pilot in Ghana around savings as well. So this behavior doesn't just have to apply to credit. There's yes. other applications of it.
It can apply to a lot of services. For example, naturally you will need to be convincing enough also to the telcos what's in it for us. So sometimes the telcos will ask, can you help us scale our airtime credit business? Can you help us scale our prepaid airtime business? So because it gets into the heart of the behavior and we create scores, credit scores, risk scores, response scores. We're able to help increase, make marketing campaigns more efficient. We're able to help them finalize scores. We were able to help them get better responses, positive responses. So we're piloting this, and we have already done some initial tests, and then we're proving this through some tests that we will need to do before we commercially launch, probably first quarter or second quarter of next year.
So this is a solution that when we throw these numbers out there, we say there's 2.5 billion people underbanked, but somewhere around 1.6 or 1.7 billion of them have a phone. This is a solution that works on the $20 generic Nokia phone that people tend to have. Moving from there to Jeff. Jeff, can you talk a little bit about Lenddo, your approach to sort of understanding behavior and attitudes?
Sure. So we got into we started Lenddo because we had, for different companies, we had started employees all over the world, and they kept coming to us asking for loans, which made no sense because they're hardworking, employable. So what inspired us to start this was looking at microfinance. And it was a simple observation that when you involve the community in demand generation, you get a positive selection bias, better borrowers. When you involve the community in the underwriting decision, the community knows about that borrower, you get a very good decision process. And when you involve the community in the collection process, you're able to stay in touch with the borrower and you're able to collect. And there's a social enforcement mechanism that works. So our whole hypothesis was that we could duplicate this online. Our customers are, they spend a lot of time on social networks. They're very connected to their community digitally. And we give them the ability to share that information with us so that we can make an underwriting decision. We also take advantage of the fact that their community is online to engage their community to provide additional information, like a reference essentially, so that we're able to make a good underwriting decision. And our constraining factor is essentially the growth of social networks.
If you can draw the parallel to the way Jojo framed Roland in Ghana, what does your ideal client look like? So
we target the middle class. So our Our ideal client is educated, employed, industrious. They're just underbanked or underappreciated by the local financial institutions. But it really, they're using the funds often for other people in the community, for their family. We have one woman, she was the first person in her village to ever go to college with a loan from us. It was only about a $400 loan. Her sister is the second person in that village to ever go to college. So we'd like to think that we're getting money out into the community through the part of the community that's made it into the middle class.
So it's the aspiring middle class, the people that are coming into the middle class that are still, they might be formally banked in terms of having a transaction account, but still couldn't qualify for a loan or any other service.
Exactly. We sit on top of whatever digital payment infrastructure is in country. So our ideal customer has some sort of digital wallet or some sort of account that we can fund into, and has a presence online that they can share with us. But with those two constraints met, we're ready to make a lending decision.
This is interesting. We've got two relatively contrasting yet thematically similar approaches, right? You've got deep into telco data, deep into social data, but really what it is in getting insights into behavior, community, attitudes as collateral, in a sense. This is all uncollateralized lending, but really what you're doing is going back to the fundamentals of microfinance, which is your community serves as your collateral, and that's what makes you bankable. This is finding a way to do that at scale using technology. Mark, you've got a fascinating solution that sort of cuts across some of these themes. Could you introduce us to DeMyst?
Thanks, Arjuna. So at DeMyst Data, we have a technology platform that aggregates, cleans, structures, and scores data from a whole range of different sources, hundreds of sources, including a lot of social media data, online data, a little bit of telco data, and internal data that sits within our lending clients. So we believe that there's an abundance of data in this world today, and that includes in a lot of emerging markets where we're working. But the challenge that a lot of people face is that there's too much data and a lack of resources and technology to harness it, wrangle it, structure it, and make it accessible to the credit underwriting folks who know what they're doing. So back to the the question you were asking earlier around what does this mean for an ideal client? For us, that really does depend on what the lender client of ours does today. We bring in some data that casts a wide net and says what adds the most value versus the status quo traditional credit reporting system in the country that we're operating in. In the online world, for example, just to give a couple of concrete examples, it's validation of identity is an important component of the solution. Just like a lot of you here who have met new people in the past few days will go home and do a Google search and figure out, is this person real, and can I see that they live where they told me they live, or is it a made-up name and a made-up phone number and a made-up employer? You can systematize that as one of many components within the identity verification and credit underwriting system within a loan decision. So that's just one example, but back to this overarching theme, we're running correlation analyses against a much broader array of attributes to find out which attributes are most impactful for a given pain point, for a given use case, for a given country. We're doing that today in the US, UK, a couple of countries in Asia, and we've done some testing in parts of Africa as well. So one of the great things about some of the online data sources is that they are global, there are regional differences, but no longer are we constrained by the growth and penetration of contributory data sources like the mainstream credit bureaus. Nowadays, people can be evaluated based on online data as well.
So we've seen three different models that presuppose the existence of data. There's still a number of people out there that still don't have a digital footprint. And DJ and his team have come up with a fascinating way to understand those people and still make them bankable. It's a slightly different take, but it still fits into this next generation of data analytics companies that are coming up to tackle this problem of financial exclusion. DJ, do you want to walk us through a little bit of what EFL does? And I think there's some fascinating insights from the testing you do.
Sure, thank you. So EFL stands for the Entrepreneurial Finance Lab, and it was initially a research project which set out to try to identify why there was this information asymmetry between lenders that had money and borrowers that wanted to have finance. The idea was that there's a lot of information about people. And during the credit reporting breakout, there was actually a good metaphor, which I'm going to steal probably forever. But there's no such thing as a thin file person. There's a thick file of information about someone. But in order to get that information, it's very costly in the traditional banking dynamic. So, I mean, venture capitalists do this. You sit across the table from someone, you really get to know them. Microfinance institutions do this, where you go and visit their neighbors and the people they do business with. But that's very expensive as you go upstream for the larger size loans. And so what we've done is we've sought to quantify this sort of information, this qualitative information that loan officers in intuitive banking collect on a daily basis. So things like ability and willingness to pay. Willingness, if they can repay a loan, will they? And so to take an example from what Jojo said, just a quick show of hands, what percentage of managers do you think steal from their company? Can we get a hands raised for less than 25%? Hands raised for greater than 75%? Okay, so I mean, you can ask some questions where obviously you can't ask someone, have you ever told a lie, and be able to determine if they're honest or dishonest, though if they say no, they're probably dishonest. But you can look at someone's external perception of the world around them in order to see how they justify their behaviors in the context of a society. You can also look at the consistency of their answers when something's more opaque and when something's more clear what you're asking them. So these are things, again, that you try to kind of come up with on a face-to-face basis. Training people to do this is expensive, and sending people out there to do this in wave is expensive, and it's also inconsistent. And so we borrowed from the field of industrial psychology, pre-employment screening, which is used in over 40% of companies in the States, to really cut through people's responses to see what kind of dimensions do they exhibit. Other things we measure are not fancy things like business skills. Do you know the difference between sales and profits? And are you looking at what your customers are doing? Intelligence, and then also kind of character. So that's one of the 5 C's of credit. How do you evaluate that? You can see if how they view the future. Are they optimistic? Are they driven? Do they have an internal locus of control? Do they feel as though the future is within their control, or is it just external forces and luck acting against them? And then there's also multivariable analyses on those. So if you're 17 and you're optimistic, congratulations. If you're 35 and optimistic and have been beaten down by the world for a few years, then it might mean something a little bit more. If you've had more experience, that optimism might mean something more. So really quantifying this kind of qualitative approach and helping banks understand, in concert to the other things we're talking about here, what is that individual actually like? How likely are they to be successful and pay the money back if they can't?
DJ, I think one of the interesting elements of your model is that, unlike some of the other solutions, you focused on trying to bring the SME, the unbanked SME, into the formal sector. How has that played out, and what kinds of markets are you seeing this type of model being adopted?
Yeah, I mean, at the end of the day, if you were here for the yesterday's conference, and if you look at any bank's annual reports, they say that they're tackling SME, or that the goal for next year is SME. And so there's not a bank that I've visited in the emerging market that isn't focusing on SME. But the issue is the banks, and I don't fault the banks, they're playing by the same playbook that is used around the world. They're looking for mandating credit bureau reports, formal financial statements if you have them, even identification systems in a lot of these countries break down. If you don't have that information, then it becomes difficult for the individual to communicate to the bank that they're a good credit risk, and vice versa. So, from our perspective, I just got back from a country where a bank had 6 million current clients and they were lending to less than 2% of them. I mean, there's a huge opportunity there. And, some folks at the IFC will say at conferences that 80% of folks that need access to credit are actually banked. They're inside the banking system. They probably have current accounts, but they don't have any risk products. And so, you know, in the absence of becoming a bank ourselves, I think that that's an avenue that we can work across. We're in 20 different countries, and about $200 million has been lent out against the tool that wouldn't have been lent otherwise. And so it allows us a broad kind of perspective and arm.
That brings up an interesting point, which is all of them have very different business models. It's going to take a set of business partnerships to make it work. Telco data for you, Jojo, social data for you, but you're actually building a lending institution, Jeff, and Mark and DJ, you're working with banks and helping improve their underwriting processes. Do you want to talk a little bit about the challenges of scaling this, the pitfalls of setting up these partnerships and arrangements, and you know the willingness of what I will call the incumbent providers to work with disruptive ideas like this? Sure, Jojo, you can start.
I came from an operations, and I was in bed with an operator for quite some time, and obviously we had difficulty doing scaling our mobile money initiatives. I think that's a global issue, and I think one of the maybe incentives to the telecommunications companies with this is that when we take a look at their data differently, there are several new businesses that they can generate out of it. One is that they can actually scale whatever it is that they cannot scale. And then second is that they can create new revenue streams. But as in any case, any incentive will have to be, will have to have you know, something in exchange for that. And that is what we present. We present viable services through the banks, microfinancial institutions, who would like to you know, get into their subscriber base. And then as the third party, the middleman, in two huge organizations, I think we're able to manage expectations from both camps. The challenges are always there. You know, why will I share information with you? What's in it for me? And usually what we do is we do you know, aggressive piloting of initiatives to prove to them the concept. And so far we've been rewarded with the opportunity to have a good set of database which we've used to test out some of the services. So it entails a lot of trust from these big organizations that they will get something out of it eventually. And that's something that they can sustain. So it's very, very important that you get their trust immediately. And also sometimes they tend to say that, you know, I can also do that. Maybe, you know, let's cooperate for the next 6 months, and probably after 6 months I already have something like that. So bye-bye. But we try to be ahead of that, and try to be conscious of the fact that this is a unique, a potential disruptor, and a breakthrough for them.
Do you want to talk about the experience with the banks?
Yeah, banks are great fun to work with. They move rapidly, they have no regulatory concerns, just seamless. And then when they say they're going to move, they just move.
Pie chart of who's in the room again.
Okay. Well, I'm not, yeah. So, I mean, we do work with big banks, and you have to, because that's where the scale is when it comes to lending. But the question that I'd like to add for the group is the question about the mid-market and smaller players and how they operate here. So I think we would broadly agree on this panel that there is somewhere between 10 and 30% of the overall application pool for credit globally that is being incorrectly declined. I don't want to put words in people's mouths, but there's lots of ways of counting this. There's $500 billion of loans that are good, credit-worthy loans that should be deployed. The question then becomes, okay, there's a business opportunity. Who's going to go after it faster? Is it going to be the new entrants, the disruptors, the people who are going to cherry-pick those best subsets of risks, the better MFIs, the online lenders, and outside the lending space as well, the more innovative tech companies that are delivering payment solutions, et cetera? Or is it going to be the banks that recognize what's happening and go into those markets that they've previously previously avoided. We don't know. We're working with both sides of that equation, but our experience in the last 2 years has been it's the innovators and the new entrants that are moving a lot faster at adopting these technologies and achieving extremely low default rates in the process. So, you know, we'll pursue where the path of least friction is to enable financial inclusion and good loans to be deployed globally. And I think the banks need to be careful because they might end up being cherry-picked. They might end up seeing the worst subset of loans that are applying to them as the good guys come in and steal the best loans. And they might see default rates go up based on dimensions they're not collecting and not leveraging. So it does become a game of you know, who is most ambitiously using the data. Now, back to the question about constraints. One of the challenges for the smaller guys and the 35% of people in this room that are lending institutions is there is still a lot of friction when it comes to sharing data between those institutions, whether it's engaging via the governments or directly between the institutions. So it's unclear to me, you know, how much pooling of data is really happening between MFIs today and whether more is possible. It would certainly help, but whether more is possible amongst the industry.
Jeff, if I can turn to you for a second, you getting your data from organizations like Facebook and LinkedIn and Yahoo Mail,
Yeah,
they think about an ecosystem very differently.
Yeah, they see themselves as platforms. And to do that, you need to make that data available to the customer. I would say that we don't go to Facebook and LinkedIn for the data. We go to the customer, and the customer chooses to share that information with us. So, you know, we're awash in data. And, you know, a cell phone is essentially a giant data exhaust device. So between my phone and my friend's phone, you can tell an awful lot about me without an intermediary or being dependent on any one organization. On the other side we're essentially a double-sided network with customers on one side. On the other side, there's the capital. And we chose to move fast to actually set up the lending entities ourselves. But we view those lending entities as they're our customer. And where we have a competitive advantage in writing software and deploying code, we deploy code every day, analyzing large data sets. Where we don't have an advantage is access to capital. And, you know, we never see ourselves bellying up to the Fed window and pulling money down at prime, but we're long yield. And we think globally there's a shortage of investments out there, and there's, you know, retirees all over the world who are going to want their money to work for them. And our hope is that we can connect these hundreds of millions of people in the emerging market middle class who can use credit to improve their life with these large pools of capital that are looking for yield.
So earlier today when Susie ran some of the clicker polls, one of the questions was which emerging innovation will be the most important game changer? And I'm going to categorize two different questions into one category, which was one was use of big data, and the other one was social media-based business models. So if you look at those two categories together, it was the single largest potential game changer, even in the old crowd. And I'm presuming, given the optimism that I found from the initial poll, that this crowd would agree. What was more interesting, though, was a question around what are the biggest risks for new clients entering the market. And misuse of private data was only 2%. The biggest concern was becoming over-indebted. Narda, from where you sit, how did those two responses strike you? And now, having heard and reflected on what the four other panelists have said, do you have a different point of view from what you think the crowd reacted to?
Well, I guess, first of all, it's fantastic to hear these initiatives. I don't want to be the one who is going to spoil the party.
That's what we have.
Anyhow, I just would like to perhaps ask a question and express a concern, which is more or less related to what you mentioned. Pertaining to the question is about this trend that is happening in many countries of adopting very strong frameworks of data protection and data privacy, mandating basically confidentiality and requiring some specific things in order to lawfully access the information. One of those things are something that you already mentioned, is that there has to be an express consent of the data subject in order to use the information. And that consent has to be prior has to be free, and it has to be well informed. So I guess that might impose some cost to the providers or these initiatives in exploiting the information. I don't know how this affects the ability to exploit the information. And pertaining to the concern, it has to do to that 2%. And it's also related to this question I just asked you. Whenever you are informing the data subject about that they are about to use that information, it's very important to be truthful, communicating the information for what this is going to be used. And it is very important to be transparent. So in a way that the person affected will not feel that he or she is losing data privacy. And of course, talking about data privacy, we have to take into account, particularly dealing with the poor, that there are some studies that shows that the privacy of information is very important for them. And we need to keep the balance between keeping this privacy and having this opportunity of accessing to financial services. And another concern is perhaps on the way. There is the research stage, and then there is the marketing, I guess, process. Once you have the information processed, and you have perhaps a pool of potential customers, how this is communicated to these customers? I mean, how do you control that the marketing, selling the product, delivering the product is going to be in a transparent way, in a truthful way? So that you can take into account the preferences of the consumer in terms of keeping or not their privacy, the needs of the consumer, and their ability to handle the new products, to handle the risk associated to these new products.
Jeff, on that point, you're trying to proactively address the financial capability issue. You want to talk about how you think about that as part of, sorry. Please go ahead.
It wasn't clear to me if what we are measuring is willingness to pay or ability to pay also in your initiatives.
Maybe we should address that first, the willingness versus ability question, and then we can go to the consents and capability.
Sure. So I would say more than anything else, it's the willingness to pay. That we're measuring. Who you associate with, who's willing to vouch for you, what communities you're part of, and what that community thinks of you speaks to character. And we think that character is the foundation for good credit. That said, there's an enormous amount of data that goes towards level of indebtedness, lifestyle, expenses, income. It turns out that if you work someplace, your social network is going to sit on top of that. Your geospatial footprint is going to intersect with that. And you can, with a high level of probability, predict someone's income by looking at their social graph. So we are looking at both ability to pay and willingness to pay with our algorithms. But to the data privacy question, I think regulators have their work cut out for them because first of all, the data is supranational. If I'm corresponding with my friend in Germany, where is that data? And if he sends me a message, is that his data, or is that my data, or is it somehow shared data? So this, the information that we're using is not just the person's information; it's their community's information. It's more of an epidemiological model as one of the cornerstones.
If you have the luxury of being able to ring fence it because you are the lender, but for the other models that are out there, you're actually acting as an analytics provider and an enhancer of decision making, sitting between the data and the actual lender. How do you think about your role as the technology and the analytics in between? And is it incumbent on the lender to think about the issues that Narda has raised, or are they things that you're actively thinking through? And we can go in order.
We provide, the objective of Cignifi is to give, for example, the lender or the one offering the credit product to the consumer, the opportunity to believe that the consumer is not only willing to pay, but willing to accept an offer. Okay, so we can come up with all of the offers. You can come up with insurance product. But the first thing is the consumer willing to accept an offer? So you go through a process of coordinating with the channel, maybe the telco, and then maybe go through the same their opt-in approach. There's transparency which they're required to go through anyway. So if the consumer accepts the offer, the behavioral dimensions that we provide the provider of the service also gives them an appreciation of the consistency of the behavior that will tell you that this consumer is also going to be willing to pay, meaning he has a very, very low degree of default that makes him a very, very good candidate. So those are the two things that probably in a role to be a data analytics provider, confidence builder to the service provider. Those are two things that we are mandated to provide to the service provider. Data privacy, because again, we provide information. It's actually not our product that goes through the service. It's a product of maybe a loan provider or maybe a product of the telco. So we ride on their we ride on their requirements for transparency. We ride on their requirements for being able to protect their consumers by offering that particular product. So.
As partners with banks, any perspectives, Mark or DJ?
From our perspective, it's part of the bank application. So someone's taking the bank application, they're providing this information. And from a privacy perspective, we give the bank a risk score that looks like a credit score, a FICO score, and so they kind of plug that in. No personally identifiable information is transmitted. And since we work across 20 different countries, we have to understand the regulations. And to Jeff's point, I think that there's a lot of work to be done, catch up on the regulator's side when you have cloud computing. If people are storing their data, their bank backends in the cloud, where does that information reside? And to what degree is PIIs available across borders? So we just kind of fall into line with what the banks need and pretty flexible that way.
I just want to focus on this issue of privacy as well. I think it's important to distinguish between the privacy trends that are happening in a lot of countries outside developed markets. So places like Singapore and Indonesia and South Korea and countries that are really tightening up on this. It's important to distinguish between the markets like advertising technology and credit and identity assessment. We're operating in a world where customer opt-in and permission is happening as part of an onboarding process, whether that's for an account, for a loan, for a prepaid card, whatever the product is. So there is the ability at that point in time to communicate to the customer clearly, if you allow us to access this data, then we will do something for you in return. Now, the lending institutions haven't done a great job of really communicating what that means yet, beyond the fine print. But that positive feedback loop for customers is possible. So that's how we operate. We don't actually need to store any of the data. We do operate with PII, we do operate with private data, but you don't need to store, house, and leverage the data except at that point in time that the customer is expressly saying, yes, I would like you, the lending institution, to evaluate me and everything about me, whether it's my mobile phone or my social graph or something else, because I think that's how you'll get the best picture of me. That's how you'll give me the lowest rate and give me the capital that I need to run my business. So that's the main comment on the privacy issue.
I think there are a number of themes we could continue to explore, but I do want to give some time for the audience to either opine or ask questions. This was an incredibly optimistic audience, so I'm not sure. Let's try this. We've got another poll question before we go to the audience. Probably gives people a second to get mics. So, we hope there were a lot of people in red and we could move some of them to green, but here's another set of questions. Now, how do you feel now? Still don't believe the hype? No time to answer, too busy reading the fine print regarding privacy settings of every online service I've ever used? Maybe there's something worth exploring, or, why 2020? We can have financial inclusion in 2015. Where do people fall on the spectrum now? And then we can go to questions and thoughts. Okay. Great. Okay, so we're still at 20% in the first two categories. That's great. Before we start with questions, I'd love to bring Kate McKee from CGAP in just to get a very quick second of her thoughts on all of these issues around consumer protection, as she's one of the leading thinkers in the space and would I think, add to the debate.
Thanks very much. So it's a very exciting topic, and you all have presented a really optimistic picture. And I think we all can see the potential, and I'm just not buying the sort of don't you worry your pretty little heads about the risks that are involved. And in particular, I guess there are a couple of just observations I'd like to make. I haven't heard it in the last couple weeks, but it hasn't been long since the last time I heard two operators debating who owns the customer. You know, this is a bank and a telco. Who owns the customer here? And I think we need to get a little clear in an environment of data being commercialized, that it's an asset and customers own it, and that we are perhaps have been a little cavalier in thinking about how that's going to play itself out. So that's one concern I have, and in particular, I think with the informed consent process and how it would really work when it's not a middle class or aspiring middle class 24-year-old, in their second job with an active Facebook profile, but where it's more the kinds of people that we're talking about from a financial inclusion standpoint. So I think that's an issue that really needs more exploration. And it's not even, I think, who made the point about I don't have to collect and store the data. I use it at the point, and people are giving me consent. I guess my impression is that some of the business models actually, they want to use that data for purposes they're not quite sure of in the future. And so we need to be thinking a little bit beyond the immediate transaction. Just one final point I want to read to bring is that as the value chain of delivering any one of these services is extended, particularly I think in developing countries, that surely there are some data security issues that are maybe somewhat distinctive from the data privacy issues that we need to think about in terms of unintended consequences. And then, I'm sorry, just one final point. The 2% who said people are worried about their privacy, and the whatever percent it was who said I'm worried about over-indebtedness, those are not unrelated responses. So we have, for example, in Kenya now, an instant loan, a push instant consumer loan that is underwritten based on data, including mobile data as well as traditional credit bureau data. And I'm not sure, I don't want to be paternalistic. I'm like Narda, I don't want to be the one who spoils the party. But I think that kind of business model is something we should be thinking about in the context of financial inclusion and the potential in certain segments, and given what we know about behavior, for that to have some unintended consequences on the rapidity of which a particular segment could get pretty saturated.
So I'm aware of the time, and Susie's sitting in the corner, and I know I'm going to get into trouble if we run over. Instead of rebuttals, I think there's enough interest in the crowd to ask questions, so why don't we...
Hi, Arjuna, and panel. I think it's Richard Leftley from MicrofinanceAnalysis. About a year ago, we had a joint venture with Telenor, and they had 51%, so suddenly we became kind of part of the Telenor group. And as a result of that, I, for the first time, was allowed into their big data room. And the guy was kind of keen to show off to me. So he asked, I'd been in the country for like 2 or 3 days, and he asked me my phone number. And he typed it into his machine, and out popped how old I was, how much money I earned, which country I lived in, all of which were fairly easy to get to. But the one that really freaked me out was how many kids I had. And I have no idea how they worked that out within 3 days of me being on their network, but there you go. I guess, I share it because it's really, really powerful information, and I get why what you're doing could be huge. But from coming from the background of having been an independent company, like most of you are, and then being owned, or part of my company being owned 51% by a mobile phone company, it took that ownership of 51% to be able to get them to a point where they shared that data with me. And prior to that point, they weren't letting me in that room. So I think what you guys are doing is, and I don't disagree with what Kate says about how, whether the data that you need belongs to the client or the company, but why will the company give it to you? Because it isn't clear to me that they want to give that much information to you to allow you to do this stuff.
This is Jojo from the Inclusive Design Institute, and there is a very strong correlation between being one of the excluded and not fitting the norm. So what I would point out to you is that the presumptions and the assumptions you make in your data analytics are likely not to apply when you're talking about the margins, which is what we're talking about when we're looking at including the excluded.
Stewart from Microfinance Opportunities. My organization, I want to change the focus a little. The focus has all been about credit and extending credit. We just took some data from a bank in Africa, and we looked at savings and how actually looked at their savings data, looked at the transactions data, and essentially were able to identify some predictors of dormancy. And I'm sure many of the bankers in the room know that dormancy is a huge issue, and analytics can be used to, first of all, identify precursors to dormancy, but also then begin to enable banks to refine their products, refine their service delivery processes, so that in fact it encourages savings. And the other hat I wear in this is I do financial diaries, and the financial diaries work that I've done indicates that savings is a critical financial tool for almost everyone, and that in fact credit is a very seldom used by low-income people. They try and avoid credit at all costs.
Hi. I was fortunate enough recently to actually play with some of these tools. And we were looking at them particularly for things such as authentication. And one of the things that became blaringly concerning to us is using social media to gather your information. I'd be curious to know or to understand more how you decipher those the characters of or behaviors of those individuals who have multiple accounts, for example, or multiple personas, one because of their personal involvement, the other because of their social. Thank you.
Okay. Lots of different interesting comments there, but just one response to the marginal customer being different, and this does relate back to the privacy and regulatory constraints. We're subject to a lot of stringent legislation as well because we do handle private data. But the marginal customers in our experience across the 20 or so million records that we've looked at are vastly positive. In other words, people who do have deep and consistent online profiles are, all else being held equal, much, much, much better identity and credit risks than the norm. And it's surprisingly universal regardless of what country that we're in. Now, that doesn't diminish the need to protect customer privacy and control the data in the right way at all, but it does raise the question of what happens when the regulation goes too far, when the privacy constraints go too far. It keeps vast swaths of people off the grid, and just because we haven't managed to have the conversation about what all of this means with respect to the customer, that doesn't mean that the right answer for society is to restrict people from engaging in things. And we spend more than our fair share of time with our own counsel and our clients' counsel and with the end customer, so we feel pretty comfortable. But I think it is worth just highlighting that that marginal customer is a great customer. That's why all of these alternative lending models exist. In terms of the cross-validation of personas, that's one of the hard technology challenges. That's, how do you really know you've got the right Mark Hookey on lots of different platforms? We spend a lot of time on that, but that's a whole 3-hour side discussion, so I won't jump into that.
Jeff, do you have a response to the multiple online personas issue?
Yeah, it's been a non-issue for us because we're not looking at the person's profile. We're looking at the person's profile and their friends and their friends' friends and their friends' friends' friends. So pretty much everyone's connected back to us, people we know personally. And those connections, those networks for humans cluster in very predictable ways. So you can fake an online account, you can fake a couple friends, but you can't fake the thousands and thousands of friends that you're connected to and the way that they're connected to each other. So I think that whole problem just disappears when the user has a piece of code on their phone that makes it easy for them to share that information with the lender.
I think we can sneak one more question in because Richard and the point around savings, I think, are well taken points. We could have a richer debate around it, but I want to get one more voice before we. Please. I'm sorry, with the glare, I can't see beyond 5 rows, so if there are people in the back, I apologize. Susie, 5 more minutes? We can run 5 minutes over?
Okay, for you, 5.
See.
Hi, this is Tanaya from CGAP. My question was, how close do you think in financial inclusion we are towards predictive analytics, the kind of stuff that Target does where they know, a woman's pregnant even before she knows it. So, but really my question is around, okay, how do we predict how customers are going to behave even before with whatever data we have? So if I offer them tomorrow an insurance product or a savings product, how will they actually behave? So any thoughts on that would be great.
I'd say we're there. The technology exists, and it's money is being sent around and lent today using the predictive power of this data and these algorithms.
Yeah, we have proprietary ways or analytical tools that basically aggregates and combines different behavior. How many minutes you use a day, how much time you use it at night, how often do you get to zero balance, how often do you top up. When we combine all of those, we basically use a proprietary analytical tool that gives an appreciation of the volatility of this person in terms of maybe risk, default risk. And we have proven that it works. We have piloted it in some countries. We're using some of the information for some of the other pilots that we're starting with. On the question of Richard, as I mentioned earlier, it's a challenge. It's a challenge for telecommunications companies to share their information with you, and then it's a challenge for us, for them to give it to you and analyze it, and then we will keep the information on what we analyzed. So we create opportunities for the telcos to create new revenues for them, and it's going to be very, very clear. We challenge business models. We bash it with the business models of a bank, and we create opportunities where they can coexist and come up with a service for the excluded. Again, it's a very ideal state of making it work, but we have been so far been successful in getting them on the table to explore opportunities.
DeMyst, just to respond to the question you asked. A lot of the predecessor for a lot of these analytics was actually loyalty card data type things. The founder who came up with the algorithms behind Cignifi is a behavioral mathematician who built a company to understand loyalty card data. So when we think about the arc of big data and trying to understand customers, it did come out of the FMCG and the retail. Right now we're starting to see other digital footprints beyond the card footprint that's now penetrated multiple markets, and now we're trying to get the insight. Sonia, should we do one last? Yes.
Yeah, I just wanted to, as someone who's been in microfinance for quite a while, I'm wondering what the panel's view is on, will this data kill the group lending business, and when?
Group lending.
Yeah. I would say just the opposite. I think the group lending, that's essentially what we're doing, is we're engaging the group in the lending process. So I think that peer-sourced capital is inefficient. You're essentially creating a lot of complexity to take money in when there's already big pools of capital out there. But I see this very compatible with group lending, and a mobile phone, which these phones will be $20, full feature phones within 40 months, allow you to do group lending in real time across distance. So I think we're going to see a renaissance of group lending thanks to this data.
I mean,
Just to clarify, I meant microfinance institutions offering group lending approaches, as in the model we see all over South Asia.
I'm no expert on microfinance, so I probably shouldn't be talking. But I guess if you view group lending as solving the selection issue, then the more data you have, and you can call it killing, you can call it disrupting, whatever makes it sound sexier, the more data you have, the less you need to depend on informal networks in order to do selection. And again, no expert on microfinance, but in the group lending model, it's a bit inefficient in the sense that the individual doesn't get access to the amount of capital they truly need, or the time with which they have to wait to get it is not quite optimal because you're relying on that group to both choose folks and to also enforce the commitment. So I think that those, from my perspective, I think those will continue to evolve as we get more information. It doesn't come from big data necessarily. I mean, the more you have credit bureaus and things like that, that evolves.
From my perspective, I see it as a specialization issue, that distribution will always be important, and sometimes that's offline. So that will continue to happen. Managing data and performing analytics is getting harder. And so as soon as the data is available, that's going to be specialized in companies like us and all of our competitors. We're not yet at a point where we can say, here's a lending engine in a box for a very, very small microfinance organization, but we actually think that we'll be there quite soon. So it will specialize around the folks that are good at engaging customers, which is not us, and the folks that are good at analyzing and protecting data and delivering an understanding of this customer is good or bad and can or cannot afford this loan.
And I wonder if there's just a reframing of the operational capabilities of the MFI. If you think about, there's been a lot of talk around the group meeting with the credit officer, right? So much time in that meeting is spent looking at the passbook and counting money and making sure the money is there. People have been talking, and I thought I saw Mr. Goldie Scott somewhere in this room. They're virtualizing that, right? Does that mean that the human connection needs to go away? I don't think so. Can that time be spent differently, engaging the borrowers and helping them with other challenges? One would hope that that's the future. Can we then use technology to understand them better and underwrite smarter and underwrite quicker? Do we see a more streamlined operation? I think that's what that's what the panel is sort of implying that we're moving towards. Okay, I'm now way in the deficit. I'm not looking towards Susie, but last word, Narda, maybe you can sort of sum it up. You've heard both sides. You've heard from Kate expressing some of the concerns. I think Richard and challenges around product diversification, as well as some of the exciting thoughts. But as a policymaker, and in a country that's amazingly thoughtful about financial inclusion and getting to the to the final person, what's your thoughts? Where would you be on that spectrum of questions?
Well, I guess I will just say that innovations are needed. We need innovations to overcome the lack of information and to use alternative sources of information. But it is important to keep the balance of being respectful to the laws of privacy, the preferences of the consumers, the capability of the consumers of repaying the loan. So perhaps just make sure that we are not developing a supply-led approach, but be concerned about what's the needs of the demand, not creating needs. I mean, it's like putting a marshmallow for somebody who really doesn't want a marshmallow, right? It's just to be careful not to over-in-depth the market. That's okay.
And I'm not sure I'm going to come up with a more colorful analogy than the marshmallow, but I think the important word was balance. To go back to Narda's opening statements, you characterize it as primitive. this is innovation that's moving us beyond that. In addition to balance, I would sort of come up with one thought, which is this ecosystem and a group of actors playing together. At some point, we're going to have to figure out this over-indebtedness issue by actually knowing who has borrowed from whom. You can't just solve that in a vacuum. It means playing with others. Jeff talks about the need for capital. Jojo talks about the need for partnership with telcos. DJ and Mark talk about the need for partnership with banks. So if Susie's ambitious goal of FI2020 and the CFI's ambitious goals are, if we're to get close to that, I think we're going to have to think about new ways of cooperating and actually tackling this problem. With that, I'd like to thank all of you for clicking along and thank the fabulous panelists I've had.